Good morning, ladies and gentlemen. And another week goes by, and yet the 10-year note remains within its pennant, and the Bollinger Bands keep on restricting. This might go on for another couple of weeks, but then it'll be decision time. If we enlarge this, we can see just how unsustainable in the long run the situation is. We have the 200-day moving average rapidly coming up towards the market. The market is only 10 basis points away from it. We have the Bollinger Bands coming in. The market might meander, holding this trend line for a while. As you know, we don't give much credence to these trend lines unless they're well broken and it sustains in time, so two or three closes well below, and then we should be able to have a sustained move. This situation is just not tenable. We will not go on for more than, I don't know, 3 weeks or something like that, trading sideways in this pattern. Just impossible. A big move is going to come, and that big move probably is going to sustain us all the way into the November midterms in the United States, and it'll have a huge effect on equities and their direction. This is a chart of the 10-year bond against the 10-year note in the States, and as you can see, it has been basically for several months in this tight range between 243, 244 and 258, a 14 basis points range, which at some stage is going to be broken as well by a move in the 10-year note. Bonds are absolutely anchored. There is a huge flight to safety into Germany, indicating something is going on in Europe, and we will show you that later in equities. But Europe is certainly a very unstable place, and therefore we are having these flights of safety. But this will be broken fairly soon, and that will give us directions in both equities, spreads, and finally in FX. Very unsustainable. We could have said that a month ago, we could have said that 2 months ago, but believe me, when you see something like this, it's not going to last forever. The market now is pricing in like it's going to last forever, and it will not. It'll break one way or another, and it will be violent, just like this was violent. And this is the move in gilts against the Bund. You can see the violence of the move, how it's outside the Bollinger Bands. It might come and retrace down to 101, 102, but then probably go and break a lot higher. If we look at where it came from, well, it came from roughly the 120 area, 120, 122, and that is probably where it's going to go back to. So when these long-term sort of restriction zones break, it tends to be violent, and it tends to produce a lot of FX volatility. In this case, it would have been the cross between the euro and the pound, and this is destined up here for 120. Any dip down towards the 100 level is a very, very interesting buy. Let's have a look at the equities from a fundamental standpoint. As we said, they are basically stuck between the 16 and the 17 time Blue Angel. The 17 time Blue Angel must be somewhere around 29.25, 29.30. That is your top of the market for the time being, while just below 2800 is the time 16. So you can see the risk reward in the market. The market might easily go and spike it to the upside, but it'll probably come back and test the 16 at some stage. So the risk reward as the market goes higher is lower and lower, and the volatility potential for the market grows, because any type of fall down to 16 is going to be violent, and that will exacerbate volatility. I thought it'd be interesting to start our overview of equities and their pricing by looking at this spread. This is the S&Ps against FEU, which is basically Europe. I don't know what you think. I think this is unsustainable. I mean, the trend definitely is higher. There is no doubt about that. But being so far away from the 200-day moving average in the long term is unsustainable, as has been proven innumerable times throughout this rise. It has always come back to the 200-day moving average. It's far away from the 50, let alone the 200. And basically what is happening is that people are abandoning all other markets apart from the US. Every spread that we look at is saying the same thing. The US equity market is the go-to for flight to safety market. People are buying dollars and people then are investing those dollars in equities. In the good old days, it used to be the treasuries. People are no longer buying treasuries for safety, they're buying Amazon for safety. Now, if you think that is sensible, great. We don't think it's sensible. Far too much risk, far too much for potential for accidents. But this is what is happening, and there is no point in fighting it until it gets to really, really silly levels. What's a really silly level? Well, who knows? It could be something like this, so we could have another 4 or 5% on the upside in US equities against the rest of the world, against Europe for certain, but it is getting to very, very overbought levels, and when the market does that, one side or the other tends to have a big move. In this case, it will probably be the S&Ps once they reach around the level we just mentioned, around the 29, 30, 40, 50 level. There will be a violent retracement back down so that the market can breathe. If we have a look at what European equities are doing, and this is the stocks in different time frames, you'll see the moving averages are pointing down in just about any time frame you look to you care to look, from the dailies to the weeklies to the hourlies. And if we enlarge it, you will see that just those levels that we said were going to be very critical around the 3500 area have proven very much to be so. The market just cannot break these levels to the upside, and it keeps on being hit to the downside. We are at very, very critical levels. If we can see continuation of these moves in Europe, we'll certainly test the 3,300 level, and below that the 3,150 level. Can this happen while the S&Ps remain very bid and strong? Yes, it can, but that chart that we show you, the spread against FEU, will then be at really ridiculous levels, and that will beg the question, what is going to happen to the S&Ps when one day people wake up and see what kind of a spread there is in S&Ps against Europe. This is a daily chart of INX, so S&Ps basically, and you can see that the market just finds it almost impossible at the moment to drop below this red moving average. It contains on a close every single attempt, and the market just then goes and spikes the top of the Bollinger Bands and then comes back and then does the same thing. It's a pattern. Every time we do break this, we go down to the next level, but you can see how the difference between the red line and the mid of the Bollinger Bands keeps on growing as the market keeps on going up. So every time it goes up, this divergence increases, and then we get potential for much more violent moves down. As far as I can see at the moment, the chances of the market breaking the 2860s is very, very low. But also the potential for the market to break the 2930s to 2940s, as we showed you, is also very, very limited. So every time we get there, it's time to have protection and buy puts or transfer your position into calls. Volatility is very cheap. There is no reason really to be long of the market when you can be either long of calls or buy some puts for protection. Uh, Both will achieve the same aim and will enable you to sleep much easier, because we are going into a period of heightened volatility simply because the situation in the long term, both in bonds and now in equities in terms of spreads, is unsustainable. This will not last forever, and when something breaks, it'll be the catalyst for big moves in everything. If we now go out to a weekly chart of the S&Ps, it is just hugging this top Bollinger Band, isn't it? And it's very well contained in these moving averages. This red one is the important one that we look at. While the market is above it, bullish things will happen. But it's also the level that it retraces to on a weekly basis, and that's just about 27.75, which is really where the market really struggled for a long time before it started breaking up. We're not saying it's going back there. What we're saying is that as the market spikes these Bollinger Bands and accelerates upwards, what it will do is will leave the space for any correction to be deeper and all the way down to this red line, wherever that might be. In a few weeks' time, it's probably going to be 2800, which actually matches up with what we showed you on the Blue Angels. Basically, the market is trading between 17 times and 16 times. As money comes in, it goes up towards 17. As people realize, well, come on, this is getting ridiculous in terms of valuation, it goes back down towards 16. But here we are. We are probably going to get some sort of acceleration upwards as this, in the weeks ahead, as this Bollinger Bands opens up. Every time we have been above the Bollinger Bands on the weeklies, we have had at least a sideways movement like here, or we've had a real mare, because the market just gets to unsustainable levels and then everything falls apart. This is what happened in January, February, and you can see that the market basically went to the red line. It fell through it because there was so much momentum and so many stop losses to be triggered. But when it settled at the red line. It never ever not traded that red line on a weekly basis. And this is probably a repeat of what's going to happen this time. It's going to go and spike the top and then come straight back to the red line. We don't often show you the Nikkei, but it's interesting that the only market which is even remotely holding its own against the S&Ps, it's not holding its own, it's losing, but it's the one that's losing the least, let we say, is the Nikkei. So what is the Nikkei likely to do here? Well, there's no point in really even thinking about the Nikkei until it closes above 23,050 on a weekly basis. A close above 23,050 will then put us in a bullish situation, and that will be also a hint for you that the S&Ps are accelerating, because the Nikkei and the S&P seem to be trading more or less in tandem, i.e. the Nikkei is the one that's losing the least against the S&Ps. So if the Nikkei gets bullish and closes above 23,050, 70 on a weekly basis, it'll be time for these weekly Bollinger Bands to start moving out, and that you will know that the S&P is more likely than not to accelerate to the upside to unsustainable levels before it comes down. Rather than keep on showing you spreads, I will from now on show you actually the speedometer, which is a distillation of all the spreads we follow. And basically it tells the story. It is very green. It's telling you that the market is aggressive and that there isn't almost a single spread which is in a risk off phase. When this is in this position, certainly equities are going to outperform bonds and keep on outperforming bonds. The overall models are about to give buy signals for equities, to be invested in equities for the long term at any moment. Both the weekly and the weekly chart actually already is so close to a buy signal at -18 that it's just not true. So probably next week these models are all going to give us the possibility or the order to go overweight equities as opposed to bonds. So this is what is going on. The equity market strength in the background is firming. Bonds are not as strong, and the spreads all indicate that it's time again for risk on. So we are at the beginning of a move rather than at the end of a move. So this is our Bible. This is what tells us where the spreads are, and this is saying it's still risk on. There is no reason to go for aggressive risk off. The dollar is basically doing exactly what we think. It's basically anchored at the moment at 95.07. It can't break 96.50, and there is no selling pressure to take it down to 93.63. 93.63, if you remember, is the level where we want to buy long-term options, because we think is going to be so pivotal for a huge move up or down. The way this thing is performing, we are more likely to go and test 96.50 again rather than come back down to 93.63. But please have these levels in mind: 96.50, 95.07, 93.63. These are levels where the dollar is very, very interesting for a trade. 96.50 broken a couple of times on a weekly basis is going to give us the most enormous buy signal, one which basically says the dollar is going to I don't know, let's put it to parity against the euro, something like that. If we look at a daily chart of volatility, you will see that we are consistently higher in terms of volatility than we were in 2017, when the market was considerably lower. Then we were trading with, at an average of say 10, and now we're trading at an average of say 12. That is a 20% higher volatility, with the market higher than it was on average in 2017. What does that imply to us? It implies that the market is actually agreeing with us, and that the US is in an outperformance mode that could last a long time. But also, as the outperformance keeps on going on, as we showed you, the room between the technical levels increases, and therefore there is more potential for the market to fall to sustainable levels than to remain at unsustainable levels. We are either going to get an acceleration in S&Ps above Bollinger Bands, which make it very, very vulnerable, as we showed you earlier, in which case the fall is going to be even harder, or we're going to have a period of whippy trading between certain levels, and the market is going to be supported. But in either case, it's going to be volatile, and it's going to chop people up. So volatility is actually telling us that people have reached the conclusion that it's better to buy calls and just be long of calls and keep on rolling them, which probably is not such a silly idea. Or be long of the market and keep on buying puts and keep on rolling those puts. That is probably the best way to keep invested without being taken out to the cleaners every couple of weeks. The interesting chart, and this is a daily chart, and we waited a while to show you this, is actually IWM, which is basically the Russell 2000. It has definitely now broken. We were doubtful here, but we are no longer doubtful here. This market is probably going to go quite a bit higher. But as you can see, Every time it does this kind of acceleration like it did here, then it falls back to the 200-day moving average. It tries acceleration, falls to the 200-day moving average. So that is why volatility is higher, because the potential for falls is that much greater. The direction might be up, but the probability of a fall increases every time the market goes higher, and that's why volatility will not abate for the foreseeable future. What the market is telling you, either just get long of calls or call spreads, or get long of the market itself but have put protection, and that will enable you to stick with the position, because when the market is doing this, it's actually more likely to accelerate at some stage rather than come down and keep on going down. So what you need to do is get long of something that will enable you to stick through the bad times of the market, because there will be bad times, and those are long-term calls or long-term call spreads. And that is why volatility, we think it's unlikely to reach the levels that it reached in 2017 again. This is XLF against SPY, and it's giving us some sort of warning signals, but nothing very much. As you know, XLF is a very large percentage of the S&Ps, and it's just it's got no zip. It should be doing something better than this, and we showed you the important chart, which is the chart of the XLF against the yield curve, and you can see how big this divergence is. This is telling us that any break higher is in S&Ps above the Bollinger Bands is unsustainable, because XLF will bring it back all by itself. Even if XLK keeps on trucking, XLF just hasn't got the strength to do very much, and therefore the market will be tradable. It will not be a one-way street. In conclusion, our biases haven't really changed very much. This is what we wrote last week, and we stand by it. This situation in 5s and 10s and 30s is unsustainable. Big moves will come soon. We don't know which way. We are fearful of the downside, but we're absolutely not certain. SPX, we basically told you to the tick where it would be, where the top would be, and it's heading for the top of the weekly Bollingers, as we showed you on the chart. We are looking for accelerations in both ways, i.e. probably a spike through the top in the next couple of weeks, and then a retracement to one of the more sustainable moving averages, again as we showed you in the early videos. NQ is the new safety trade. People are buying Amazon and Apple as a safety trade. We don't know how sensible that is in the long term, but at the moment it's working, and there's absolutely no point in fighting it. We don't fight trends, we jump on the back of them when they make fundamental sense. At the moment it neither makes fundamental sense, nor is it technically correct to even think about shorting Amazon and or Apple, but it's definitely time to transfer your long position from cash into calls and give up something, but have the safety of being able to withstand those downdrafts, which will happen. There will be downdrafts, believe me. XLF, as we showed you, just can't get off its arse. To us it's dead money. We would just avoid it. No point in being short of volatility here. We've shown you how we don't think cash vol is going to go much lower. Yes, you could make 40-50 ticks being short of vol, but it's just not worth it. It's a market which you only want to play from the long side when volatility gets really, really cheap. European equity is the trump card. We expect big things here because it's either going to catch up to the US at some stage, as we showed you, or it's going to break down hard, as we showed you again. So to us, European equities are going to be the leader at some stage. People are now coming back from holiday. They're going to have a look at the levels and make up their own minds. If we can't rally in the next couple of weeks in European equities, the odds increase that they will break down hard at some stage. And finally, we've shown you all the levels in the dollar. 93.63 to us, it's so pivotal, so important that basically that is the level to keep on looking at. And 96.50, if we break that on the upside and stay there for a week or two, we are just gone. We are gone to much higher levels, way above par. Thank you very much indeed, and tweet to you on Monday.